Today, we are particularly pleased to welcome Juan Carlos Berganza from the Bank of Spain. Juan Carlos is head of the Latin American and Emerging Economies Unit at the International Economics and Euro Area Department of the Bank of Spain. As you know, Spain has a twice-yearly report on the Latin American economy. The report was launched in the summer, and Juan Carlos will talk to us about the key findings of the report. The timing of this seminar is very good for us here at the OECD. We're starting our cycle, our process of preparation of the upcoming economic outlook that will come out later in the year. This is a process where we look in detail at the trends, at the evolution, at developments in Latin America. So it's very good to compare notes with Juan Carlos and to assess our respective views of the challenges and the policy developments in that part of the world. Without any further ado, I would like to invite Juan Carlos. Juan Carlos will make his presentation. For those of you who would like to share comments, ask questions, please do use the chat option. We'll then collect those questions and give the floor back to Juan Carlos after his presentation. Also, please do bear in mind that we are recording this session so that it can be disseminated more broadly later on. So with that, Juan Carlos, the floor is yours, and thank you very much again for joining us today, and congratulations on what is a very interesting, very useful report. Floor is yours.
Thank you very much, Luis. First of all, I would like to thank the OECD for giving us this opportunity to present our report. As Luis has mentioned, we publish the report twice a year, and we also publish another reports. Some of them are mentioned here in this slide. For example, at the same time that we publish our report, we publish macro financial indicators for the main countries in Latin America, and also for the Central America and the Dominican Republic in a jointly work with the Secretariat of the Central America Monetary Council. You have the front page of the Brazil one on your left-hand side. We also publish twice a year vulnerability indicators for emerging countries, which are material for the Spanish banking system. That is the main reason why Banco de España analyzes Latin American economies, due to their particular relevance for the Spanish economy in terms of bank exposure, apart from, of course, capital and trade flows. Mainly, this publication contains heat maps of these vulnerability indicators, public finances, external accounts, etc. An indicator representing the likelihood of being in a vulnerable state, a kind of early warning indicator. I talk about some of those in my presentation. At the same time, with monthly, we publish economic policy uncertainty indexes for those countries. These are built using the larger set of available newspaper in following Baker and other authors. So just to present that we have a whole and just to invite you to look at it in our web page. Regarding the report, in this case, the title is entitled "The Main Determinants of the Monetary Easing Cycle." And I think that this gives you an idea of what we look into our report. Apart from that, from we have 4 boxes in this report. I will mainly talk about 2 of them in my presentation, but the boxes are about the some description of the recent developments and inflation and other economic variables in Argentina. Another box which sets out different public debt scenario for Brazil and Mexico using a new sustainability analysis tool which has been developed by Banco de España. Box 3 prepared in collaboration with the OECD Development Center provides an overview of tax revenues in Latin America. And lastly, a box about the which examines how bank lending in Latin America is affected by domestic and international monetary policy, drawing a distinction between domestic and foreign banks, and also within this later group, we single out the Spanish banks. It is true that the report, as Luis mentioned, was published at the end of July. We have updated some figures and charts for this presentation, and also some messages. The idea of the report is it is written with the aim of sending messages, clear messages, and those messages are endorsed with charts, figures, tables, and with the help of some econometric estimations. That's the idea of the report. If you take a look at it, so as I was saying, you want to take some ideas, the main ideas of the report are those which are here in this slide. The monetary easing process in Latin America, which started more than 1 year ago. In fact, it started in Chile in July 2023, has progressed in line with market expectation, as has been consistent with business cycles and the pattern of falling inflation. At the same time, it has been heterogeneous across countries in terms of scale, pace, and duration, due to differences in cyclical conditions, inflation levels, and fiscal policy stances. For the future, financial markets expect further cuts, with one key exception, which is Brazil. In fact, many analysts and markets expect a hike tonight in their monetary policy meeting. These cuts have a limited scope in several countries, and of course, this process will be influenced by the U.S. monetary policy decisions. We also have a very important meeting tonight with the Federal Reserve deciding about if it goes 25 or 50 basis points. Inflation is expected to decline in the following quarters, and within the inflation target ranges of the central banks. But for that, analysts expect that the economies continue to grow at rates close to their potential, and no very large positive output gaps arise. It is very important for that process the credibility of central bank, which will continue to anchor inflation expectations. But at the same time, this inflation process will remain gradual, given the stickiness of the services component, which is a characteristic seen around the world, not only in Latin America. This monetary easing cycle, at least until now, has not been accompanied by financial market upheaval or capital outflows. And as I mentioned at the start of my presentation, banking systems is very important for us to know what happens there. We have seen that lending has picked up slightly since this monetary easing cycle started, and it's expect to gather momentum in the next quarters. At the same time, we have the idea that risks to the banking system are contained. So my presentation will talk about these main points. We'll try to illustrate these ideas. For example, as we can see in this table, the monetary policy cycle in Latin America started in the second half of 2023. Mexico at a larger stage. The same happened in other emerging market regions, as in Eastern Europe. In this table, blue denotes monetary policy easing, with the intensity of the color indicating the scale of the change. For example, a 100 points cut is darker blue. This gives you an idea that previous to developed economies, some countries in emerging market economies, those in Latin America and Eastern Europe started their cycle. It is an uneven cycle. We have seen only 50 basis points cuts in Mexico and 575 in Chile. And this is explained by the business cycle, developments in inflation and fiscal policy, as we'll see in the following slides. Another important idea is that the monetary easing cycle began when inflation was still above the central bank's target ranges. See that in this chart, which is the inflation year-on-year change, the blue line, the policy interest rate, and the inflation target ranges of the different inflation central banks. Key in the chart is the note for each country the month immediately prior to the beginning of the rate cuts. So you can see that they started to cut rates even when inflation was clearly above the target. But it is true that it had been on a downward trend for between 9 and 17 months from the peak of the inflationary episode. This monetary policy cycle, these policy interest rates cuts are in line with those resulting from the application of a broad set of tailored rules, as you can see on the left-hand side chart. These tailored rules, as usual, account for the business cycle, the output gap, and observe and expected changes in inflation and inflation expectations relative to the target, inflation gap. You have the inflation gap and the output gap for the main five IT Latin American countries on your right, and comparing the second quarter of 2023 and the second quarter of 2024. As you can see, from the left-hand side chart, which shows the a set of Taylor rules depending on the coefficient of the Taylor rule and the use of different measures of inflation or inflation expectations. The policy rate is in the set of close to the median of these set of Taylor rules, and is inside the range of these Taylor rules. related to the output gaps, as you can see, Brazil and Mexico maintain a positive output gap, although it has narrowed in the case of Mexico. Colombia and Peru and Chile are close to having a close output gap. As you can see on the left-hand side chart, um, financial markets. Uh, 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 in that chart, you can see the peak of the policy interest rate in this current episode of tightening, the policy interest rate at the end of August, and what financial markets discount for the end of this year and the end of next year, 2025. As you can see, few further reduction are expected in Chile and Peru. There is a greater scope for rate cuts in Colombia and Mexico, and hikes are discounted for Brazil. A moderate and short hiking cycle, but it could start today. At the same time, as you can see on the right-hand side chart, and if you measure the monetary policy stance by the difference between the real interest rate, the real policy interest rate, and a neutral interest rate measured according to the estimations of the own central banks in the region. At the end of next year, monetary policy still would be will maintain a restrictive stance at the end of that year. One of the main changes in inflation, of course, will be shaped by the performance of economic activity. And this is what this slide is about. In this sense, Latin America economies will likely see growth at around their potential rates in 2024. This represents a slowdown from 2023 in Brazil and Mexico, and an upturn in Chile and Colombia, which saw low growth in 2023 in the wake of overheating, and as well as in Peru, which was affected, and as all of you know, by negative supply shocks. It is true that growth in Brazil, since we published our report, has shown positive surprises, in the sense that if we consider the GDP growth in the second quarter of this year, quarterly it was 1.4%, which is excluding, of course, the recovery from the pandemic. This quarterly rise was the strongest in nearly 12 years. Apart from that, we expect that most of the economies will grow around their potential rate. And we also know that this means that Latin America will continue to be a laggard region in the context of other emerging market economies. There are in fact, there were two major external downside risks when we wrote our reports. The first one was the possibility of the US monetary policy stance being tighter than anticipated by financial markets. We all know that the Federal Reserve has implemented a very dovish shift from that moment. So the risk now will be perhaps different. But the other risks, I think, is we can see that it hasn't changed, and it has to do with China, the economic slowdown in China proving sharper than expected, owing to, for example, worsening of difficulties in its real estate sector. Um, Here we have a chart showing how inflation evolved in the first half of this year, continue to decline as a result mainly of changes in the core component. Um, uh, Although it's true that mainly related to goods prices, since the report was published, we have seen some increases observed in the non-core components, mainly energy and food. But the main idea is that the services component is sticky, as mentioned at the start of my presentation. Also, inflation in Argentina is much higher and with its own specific characteristics. This is accounted for in box one. I will not talk about it in this presentation. We could highlight three idiosyncratic issues affecting inflation. The inflation outlook of Chile, Colombia, and Mexico for the future, which are risks. In Chile, the most important issue is the reduction of the pandemic subsidies on electricity tariffs, which has significantly changed the inflation outlook, as shown in the last central bank monetary policy report. It will complicate matters to the central bank in the future. Also in Colombia, we have the recent blockades by trackers demanding a more gradual reduction of diesel price subsidies. Inflationary pressures could increase due to the supply disruptions caused by these road blockades. And finally, in Mexico, the push for the AMLO's push for the approval of his reform agenda has been causing a significant depreciation of the Mexican peso, which will bend the country's inflationary trajectory upward. We have for this report we work with the Executive Secretariat of the Central American Monetary Council to elaborate this slide, this idea. In this chart, we try to show how the services inflation remains highly persistent in this recent episode. We have calculated the inflationary persistence for core services inflation. We have calculated it by looking at the relationship between the monthly inflation rate, the seasonally adjusted monthly inflation rate at a given point in time compared to the previous value. We have rolling regression for 48 month rolling window to track changes. We have here the range of coefficients for 2005, 2019, which is the blue interval, and we have the median for this period, and at the same time we have the coefficient for April 2024. We can see for Brazil, for Chile, and for Peru, which is higher the value of this coefficient for this month compared to the median, and but is especially important for the cases of Colombia, Mexico, where the services component is very persistent. If you remember from the previous slide, we have here in Colombia on the right-hand side chart the persistence of services inflation, which is higher than in other countries. We have another way of seeing it in this slide. This persistence of services inflation will continue in the short and medium term. For that, we have these two figures, these two charts in this slide. On your left-hand side, we have the long-term relationship between goods and services relative prices. You had the pre-pandemic trend, which was separate during the pandemic, in the sense that the goods prices began rising much faster than the services prices. This trend continued until just a few months ago. This faster goods inflation was driven by consumption patterns during the pandemic, and at the same time the emergence of some bottlenecks. However, the year-on-year change in the price of services has risen since above that of goods in September 2023, and is again in line with the pre-pandemic trends, as you can see in the blue line. We have an econometric model, error correction model, estimated for 4 countries of the region for the period prior to the COVID-19 pandemic. And according to that model, which adjusts historical developments in this relative price, we will project growth in services prices for the coming quarters, standing at around 4 or 5%, against an average of 2% for goods. That's the lines on the chart on your right. If that were true, that would mean that the services inflation in Latin America will remain high in the near term. So a risk for the projections. However, according to the surveys conducted by the region central banks, inflation will continue to decline gradually. You can see that on those charts in this slide, but also with the section with only in Chile, these medium-term inflation expectations will stand just in the point of the inflation target. Inflation expectation, long-term inflation expectation have remained anchored in the region, in spite of the fact that this current inflationary episode has shown the largest deviation in scale and duration of inflation. As you can see on the left-hand side chart, on the x-axis, you have the difference between the peak inflation and the upper limit of the range. In this episode, the blue points, and in previous episode, the red points. And on the y-axis, you have the months with inflation above the target range. So this episode has been more important in terms of scale and duration, but inflation expectations, the long-term inflation expectation measured by the consensus forecast has remained around the middle value of the target ranges. Perhaps the exception is Brazil in recent quarters, and that could be linked to fiscal policy reasons. I mentioned at the start of my presentation that policy rate cuts in the region could be influenced by U.S. monetary policy. On the chart on your left shows that what was discounted for the end of this year, at the start of 2024 and at the end of August. You can see that for the end of this year, now compared to the start of the year, higher policy interest rates are discounted for Brazil and Mexico, similar level for Chile and Peru, and lower level for Colombia. And at the same time, at the start of the year, markets did think that the Federal Reserve will have already cut around 100 basis points. This has not been the case, but now they discount more cuts for 2025. This reduction, this convergence of the policy interest rates is one of the explanations of the depreciation of the currency of the region, as you can see on the right-hand side chart. It is shown the evolution of the different currencies since the tightening, the easing cycle started in the different countries. So the most important depreciations you can observe in Chile and Brazil, the two countries which started earliest. And also a very important depreciation in Mexico related to all these reforms which are being passed in Congress in Mexico. In fact, the Mexican peso now is close to the level when AMLO, the López Obrador, started his mandate. We have tried to break the exchange rate movements against the dollar, estimating a Bayesian BAR model. You can see that on your left. There are some variables which explain the depreciation of the currency, mainly related to domestic monetary policy compared to the US, but also you can, if you look at the case of Mexico, you find what we call other risks which are unrelated to the macroeconomic or monetary policy. At the same time, higher prices in some commodities have partially countered the impact of monetary policy convergence, not for those producing soybeans, which is a proxy for food commodities, but it could be an explanation for those producing metals. Financial conditions in Latin America have been easing since October 2023 to February 2024. Since then, there have been lags. The explanation has to do with what you can see on your right, the depreciation of the currency, the continuation of the policy rate cuts, the stock market gains, etc., etc. Portfolio capital flows have, broadly speaking, were positive in the first half of this year, in spite of the reduction of the carry trade. The right-hand side chart, due to the convergence of the policy rates compared to the US, and also all this financial volatility episode at the start of August with the yen carry trade. What is true is that the reduction of the profitability of carry trade in some countries had prompted some investors to shift their investment to other countries within the region. I mean, for example, from Chile to Colombia, which still has a very important policy rate differential with the US. We have also a model, another Bayesian model, which tries to explain portfolio capital flows towards Latin America. Some of the variables are there: the global risk, dollar movements, commodity prices, US policy rates, and we in that moment we thought that a US monetary policy restricted US monetary policy, more restricted at least than discounted in markets, could be a risk. So we thought about one scenario. You have the result on your right hand side chart, but that was 2 months ago. Probably now the risk scenario would be different, but you can see that in the report. Also, related to the other capital flow, the other main capital flow, I mean foreign direct investment into the region, which contracted slightly in the first half, mainly in some countries, Brazil, Mexico, and Peru. We have also another model, in this case, panel data model for 7 countries in Latin America. And the variables there are more structural ones than those of the portfolio capital flows as expected, and thinking about, for example, commodity prices, in the sense that this gives you an idea. It's a proxy for future return on investment in those countries, are also the EPU, in the sense that it's perceived as a kind of institutional quality variable. We have a scenario in our report, which reduction in commodity prices and increasing the EPU index, and what that would mean for FDI capital flows in the region. In any case, the idea is that we don't see risks on that front, in the sense that current accounts deficits are lower, and they have been financed by FDI inward inflow. Related to fiscal stance, we have here a chart on your left-hand side, to compare the monetary and fiscal policy stances. I have said how we measure the monetary policy stance as a difference between the real policy and equilibrium interest rates. It is tight for across all countries in Latin America. That's the reason why it is above the zero level. We also have a measure of fiscal policy stance in the sense that we compare the structural primary balance between between 2 years. And as you can see, the fiscal policy is more heterogeneous. It has become more expansionary in Mexico, coinciding with the election year, less contractionary in Colombia, but perhaps slightly contractionary in the rest of the country. We all know that the issue about fiscal policy in those countries, public debt is expected to grow slightly in this year, driven by high interest rates and in some cases primary fiscal deficits, also low growth. Remember about this region being a laggard in the world. You can see public debt in this year compared to a historical average. But let me go to one of our boxes, box 2. And in that box, we try to implement a debt sustainability analysis with a tool developed in Banco de Spain. We calculate different scenarios for public debt dynamics. We try to take into account some particularities of Latin America. In the sense that, for example, the importance of foreign currency public debt. The tool provides paths for the main macroeconomic variables that determine the possible future causes of public debt, such as real GDP, inflation, interest rates, and the primary balance. We have 3 scenarios for the 2 main economies in the region, Brazil and Mexico. We have a first scenario, which is a scenario in which structured primary balance is maintained for the next 10 years at the level in 2024. Another scenario with primary balance according to the state budget by the different governments, and a third scenario with primary balance according to what analysts think. You have the different paths for this variable, the structured primary balance, and you have the public debt path with these 3 different scenario, which gives a very different view of the future for those 2 countries. For those of you interested in the detail about these exercise, these calculations, I highly recommend you to read our occasional paper, in which we explain the tool and we implemented these scenarios. Let me go quickly through the banking system part of our report. Main idea is that the credit growth has rallied following the onset of policy rate cuts. You can see that on the chart on your left. Depending on the type of loan or for the different country, you have a vertical line when the monetary policy is started. But let me go to one of the boxes, which is we try to measure the impact of bank lending in Latin America of the monetary policy, but not monetary policies, but not only by the central banks in the region, but also by the Federal Reserve and by the European Central Bank. And we differentiate the evolution of this credit of the loans, or the evolution of the credit growth, depending on the capital of the different banks. We differentiate between the national or international, and in the case of international, we differentiate between those with the Spanish capital and those which capital from different countries. The reason is the business model. Mainly the Spanish banks have a subsidiary independent type of model, which make them more similar to those of the national case. And this is very important for those countries of Mexico, Chile, and Peru, as you can see in the graph, the importance of the Spanish banks for those countries. We estimate is again a dynamic panel data model. We try to estimate the effect of a tightening of monetary policy of those central banks. And the main results are here in this graph. I try to sum that up in the sense that a 1 percentage point in interest rate increase by a local central bank reduced lending by 0.42%. And this is irrespective of the origin of the capital. At the same time, a contractionary effect of the Federal Reserve of the same magnitude, 1 percentage point, has an even greater effect on the reduction of the credit growth. And this is even more important for non-Spanish foreign banks. The Spanish ones behave as the local ones. At the same time, another important result is that we don't find robust evidence of that the ECB monetary policy tightening has any significant impact on bank lending in Latin America. The reasons behind these results, I'm afraid I don't have time to try to explain that in detail. I think is well explained in the box. But the main idea of the box is that the Federal Reserve is more important for loan behavior in the region, and at the same time, the different behavior, the European Central Bank has no matter or at least we don't find significant evidence of that. And at the same time, the different behavior between Spanish, we call that Spanish capital banks, and the rest of the banks. I think I'm almost out of time. We want to give some time for some questions. Let me just end with the idea that we have seen that changes in policy interest rates have been passed through to lending rates, as shown in these charts. And although it is true that with many important differences between countries and segments, we are working on this, and we hope to offer more results in our next report. And at the same time, to highlight an idea I try to give at the start of the presentation. We have a composite early warning indicators of banking crisis. We haven't seen any significant changes in the last quarter. And very similar, this idea is also transmitted by the central banks of the region. We read all the financial stability reports of the central banks, and we try to summarize them in a figure in the report. You can also look at that in our report if you don't want to read all the reports, and the idea is the same. There are not, in spite of the fact that the non-performing loans have stabilized at a high level for some countries, they don't perceive very important risks for banking systems in the region. And with that, I'd like to conclude my presentation thanking again the OECD for giving us the opportunity to present the report. Many thanks.
Thank you very much, Juan Carlos. Thanks for covering so much interesting ground in this, and congratulations again on the report for its coverage and depth of analysis. I don't know if there is any comment or questions by anyone, but perhaps I can benefit from the position of being the moderator and ask you a question. How do you see, Juan Carlos, you alluded at the beginning to risks related to, you know, to what could be a sort of asynchronous behavior of monetary policy around the world, especially in the main economic areas, and how it may impact Latin America. I think we are seeing that that trend is probably less prevalent now than it was a few months ago, with somewhat greater convergence in the policy stance around the world. But overall, how do you see the balance of risks for the region moving forward? How do you see that at the moment, and how do you think it's likely to shift?
Thank you for the question. This is probably the main change, as I have mentioned, in the last 2 months since we published the report. Our fear was related to a more restrictive monetary policy in the US. There has been a very important dovish shift there. In principle, one would think that this gives the central banks in the region more leeway to cut interest rates. In fact, I think that's behind the 2 recent movements by the Chilean and the Peruvian central bank. But at the same time, it depends also on how financial markets behave, in the sense that if this monetary policy easing by the Federal Reserve gives way to episodes of financial volatility, it could mean a risk for those countries, in the sense that they could have to face issues related to financial stability. I'm thinking about depreciation pressures, higher long-term interest rates. So it depends on the way financial markets perceive this expected or discounted Federal Reserve monetary policy easing.
Very good. I think we have a question from Alberto, basically that you mentioned that space for additional cuts in monetary policy rates are limited. Could you elaborate on what is constraining the space for more cuts? In which countries do you see still room for cuts, and which ones are more constrained?
Let me go to one of my slides. I think is this one. This on your left, you have an idea of what financial markets expect or discount, and you can see that comparing the blue orange points. No, sorry, the red point, which is interest rates, the policy interest rates at the end of August, and the blue point, which is the green point, which is the policy interest rates at the end of next year. We have we can see that Colombia will be the one in which more rate cuts are expected. Chile and Peru, not so many rate cuts. It would depend, of course, on the Federal Reserve. We cannot forget that in those cases, policy rate are at the same level that the Federal Reserve. And this having a lower policy rate is not something that we have seen in the past. Just for very brief moments in 2007, 2008 for Peru, but it depends again on the Federal Reserve. In the case of Brazil, we expect, as I have said, short interest rate, some interest rate hikes. And in the case of Mexico, it's going to depend on what the way financial markets digest the structural reforms which are being passed in the Congress. That there is a high risk there, as seen in the graph, which try to explain the breakdown of the exchange rate. So space for Colombia, not so for Chile and Peru and Mexico for different reasons, and hikes for Brazil, at least in the short term.
Thank you very much, Juan Carlos. Thanks all the participants who have joined us today. Very useful chat with you. We look forward to having you back on this screen for future editions of the report, and we'll no doubt continue to compare notes with you, with Javier, with our colleagues at the Bank of Spain on these and related issues. So thank you very much again for making the time and joining us today. Thanks. Bye, everyone.
Thank you. Bye.
Thank you. Bye.